story you're being sold is that a $70 billion Bitcoin headline caused a banking panic. That's backwards. The headline is the match. The panic is the gas leak that's been spreading through the dollar system for years. Here's the shocking part. When the plumbing is stressed, any large visible asset reallocation, especially one that signals risk off from banks, risk on to alternatives, can become the public trigger for a private funding crisis that was already mathematically underway. Recent estimates put the global offshore dollar market, Eurodollars, FX swaps, dollar credit created outside the US, in the tens of trillions, and a meaningful share of it has to be rolled, swapped, and refinanced constantly under collateral constraints. Roughly speaking, the system is a continuous auction of trust. Who can fund at what spread, against what collateral, for how long? When that auction starts failing at the margins, the panic doesn't begin with a bank run. It begins with basis points. It begins with haircuts. It begins with no bid moments in funding markets that most people never see. And once the math crosses a threshold, the next phase is inevitable, not because of emotions, but because of balance sheets and time. If you want to understand why a $70 Bitcoin move can suddenly feel like bigger than 2008, you need to stop thinking in headlines and start thinking in mechanism. Every major currency and banking crisis in modern history follows the same chronological skeleton. First comes the setup, a stable-looking foundation built on rules, pegs, or promises, something that convinces the public and markets the system is anchored. Then comes expansion. Leverage grows, money creation accelerates, and the anchor quietly becomes a narrative, not a constraint. Debasement doesn't always mean printing physical cash. It can be the slow substitution of quality collateral with weaker collateral, the rolling of short-term liabilities into longer-term promises, and the normalization of emergency liquidity as standard operations. Then comes the crisis, a loss of control that shows up as volatility in rates, FX, and credit spreads, the precise places where trust is priced. Finally comes the outcome. The system chooses an exit. Sometimes it's devaluation. Sometimes it's default by inflation. Sometimes it's capital controls, forced conversions, or a new regime of rules. But the final step always arrives because the system cannot refinance itself forever at the old terms once the collateral and confidence cycle breaks. That is what you're watching now. The $70 Bitcoin shock did not invent fragility, it revealed it. In a stressed dollar system, asset preference becomes a macro event. If the marginal investor believes liquidity will be scarcer tomorrow, they move today. If banks believe their deposit base is more mobile than their asset book, they hedge today. If dealers believe the Fed's backstop is politically constrained, they widen spreads today. And once those moves begin, they feed a loop. Tighter funding conditions raise volatility. Volatility forces de-risking. De-risking pressures collateral. Pressured collateral tightens funding further. It feels sudden because the visible part of the iceberg is the last part to appear. Let's make it boring. Let's make it terrifying in the only way markets truly get terrified. By the numbers. The dollar system is not just the Federal Reserve and U.S. banks. It's a global network of liabilities denominated in dollars, funded through repo, FX swaps, cross-currency basis trades, money market funds, dealer balance sheets, and the shadow banking ecosystem that turns treasuries into money-like collateral. The system runs on two promises. Dollars will be available when needed, and high-quality collateral will hold its value under stress. When those promises wobble, everything reprices at once. Bond yields spike not necessarily because growth is strong, but because term premia and liquidity premia surge, FX moves become violent as dollar scarcity emerges in swap markets, and risk assets swing as margin requirements and haircuts tighten. This is why a narrative about Bitcoin can become a banking story. It's not the coin, it's the funding, it's the signal, it's the collateral loop. And the reason this follows a pattern is simple. It's time and leverage. Short-term funding makes systems look efficient in the expansion phase because you can fund long assets with short liabilities cheaply over and over, as long as rollover works. But rollover is a mathematical cliff. If a system requires continuous refinancing, then every rise in yields, every widening in spreads, every reduction in dealer balance sheet capacity increases the probability that a rollover fails. When rollover fails in one corner, everyone demands more collateral everywhere else. That's when liquidity, what people call money, stops being a quantity and becomes a price. The price of liquidity is the spread you pay to borrow, the haircut you accept on collateral, and the premium you must offer to convince someone to take the other side. And once that price starts rising, it rarely stops neatly. It accelerates. Now take that skeleton and test it against history, not as trivia, as proof. The first case study is the breakdown of Bretton Woods and the Nixon shock, because it shows how stable foundation becomes debated narrative, how expansion forces crisis, and how the outcome arrives as a regime change. After World War II, The setup was a system of fixed exchange rates anchored to the US dollar, with the dollar redeemable into gold at $35 per ounce for foreign official holders. This arrangement created a clear anchor. The dollar was not just a national currency, it was a quasi-gold proxy in global settlement. That anchor bought decades of stability and helped rebuild trade and finance. But stability carried a hidden requirement. The US had to balance the world's demand for dollars with the credibility of gold convertibility. The world needed more dollars as trade expanded, but the US gold stock did not expand at the same pace. Expansion began quietly. Growing US fiscal commitments, global military spending, and credit creation fed the export of dollars to the rest of the world. Foreign central banks accumulated dollar reserves because the system demanded it. Meanwhile, the reality underneath was that the US was effectively issuing more claims than it could honor at $35 gold. By the late 1960s and early 1970s, the crisis stage was visible in pressure on US gold reserves and persistent market skepticism about convertibility. The London Gold Pool, an attempt by major central banks to manage and suppress gold market pressures, fractured. France and others openly questioned the arrangement and sought conversions. In 1971, the US hit the loss of control moment. President Nixon suspended gold convertibility. That was the Nixon shock. The outcome was not a debate outcome. It was the inevitable exit. The system chose de facto devaluation and a transition to fiat flexibility, because the prior promise was mathematically incompatible with the scale of dollar liabilities outstanding. What happened next is what most people misunderstand. They think the 1970s inflation was simply oil prices or policy mistakes. Those were catalysts, not the core. Once the anchor broke, inflation became the release valve for a decade of accumulated imbalance. When convertibility is removed, the restraint on currency issuance becomes political and market-based, not mechanical. The expansion phase had already built the leverage and obligations. The crisis phase forced a choice. The outcome was the only available method to reconcile too many claims with limited real backing. Inflation was not just a macro condition, it was the accounting solution. It reduced the real value of debt and obligations. It shifted wealth, it punished savers, it rewired behavior, and it forced rates to follow. Bond yields did not rise because investors became moody. They rose because the currency regime changed, and buyers demanded compensation for inflation risk and uncertainty. Funding markets repriced. Volatility became structural. Gold's role changed from a pegged relic to a barometer of trust. And as confidence in the paper promise weakened, the preference for metal strengthened. That preference wasn't ideology, it was self-defense against the outcome of the mechanism. Notice the mapping. Setup: fixed rates, dollar to gold promise. Expansion: dollars exported, liabilities grow beyond backing. Crisis: reserve drain, convertibility pressure, policy break. Outcome: fiat regime, inflation as reconciliation, yields and metals repricing as the new reality. This is the same skeleton you're watching now, just with different instruments. The second case study is the collapse of the sterling peg, and the broader sequence of 1970s, 1992 UK currency pressures culminating in Black Wednesday, because it shows how a government can try to impose stability on a stressed balance sheet, how markets sniff out the mismatch, and how the outcome arrives as an involuntary repricing. Start with the setup. After decades of post-war rebuilding and periodic devaluations, policymakers often tried to defend credibility with fixed commitments. By the late 1980s and early 1990s, the UK joined the European Exchange Rate Mechanism, ERM, effectively committing to keep the pound within a narrow band against other European currencies, particularly the Deutsche Mark. That commitment was meant to import German credibility and discipline, to anchor inflation expectations and stabilize trade. It was, again, a foundation built on a promise: we will defend this rate. Then expansion and overextension. The UK economy faced structural issues, property cycles, credit conditions, and an inflation profile that did not match Germany's. Germany, dealing with reunification pressures, maintained relatively tight monetary conditions. For the UK to keep the pound in the ERM band, it had to align policy with a different economic reality. That alignment required high interest rates to defend the currency. High rates squeezed domestic growth and stressed borrowers. The system became a machine that fed on its own defense. The more the UK defended the peg, the more it weakened the domestic economy, and the more markets questioned the sustainability of the defense. This is the key point. In the expansion phase, policy choices are made to maintain appearances and credibility, often by pulling forward pain. But those choices simultaneously increase the underlying fragility. Then the crisis stage. Markets test the promise. Speculators weren't evil, they were rational. If a government commits to a fixed exchange rate, but the economy and policy stance required to maintain it are politically and economically untenable, the peg becomes an arbitrage. Pressure builds. Reserves can be used to buy time, but reserves are finite and credibility is not. When the UK attempted to defend the pound in September 1992, it raised interest rates aggressively and intervened in FX markets. Yet the market pressure overwhelmed policy. This is what loss of control looks like in FX. Your defense increases your pain, and the market reads that pain as a countdown. Eventually, the UK withdrew from the ERM and the pound depreciated. That was the outcome, the exit from a promise that could not be financed under the prevailing macro conditions. Again, map the skeleton. Setup. The peg as credibility import, expansion and overextension, mismatch between domestic economy and policy constraint, sustained by tighter conditions. Crisis. Speculative attack, reserve drain, emergency rate hikes, widening uncertainty. Outcome. Forced devaluation and regime change, which then reset the system on new terms. Why does this matter for a banking panic since 2008 narrative? Because currency pegs and banking systems share the same vulnerability. They are both confidence machines with a maturity mismatch. A currency peg is a promise to convert at a fixed price. A bank is a promise to convert deposits to cash on demand while holding longer duration assets. In both cases, the promise looks stable in calm conditions and becomes existential in stress. In both cases, policymakers can extend time with reserves or liquidity facilities, but time is expensive. When yields rise and liquidity tightens, the cost of maintaining the promise increases, and eventually the system chooses a repricing. The repricing can be in FX, in rates, in asset values, or in legal constraints, but it comes. Now bring this back to the $70 Bitcoin shock. Why does a Bitcoin reallocation touch bank panic? Because at the margin, it's a statement about what the market believes is liquid, safe, and future-proof under stress. You don't have to believe Bitcoin is money to understand the signal. In a liquidity cycle, capital rotates based on perceived survivability. When funding markets tighten, every institution with duration risk and leverage becomes sensitive to confidence. Banks are leveraged maturity transformers, often duration heavy. Their liabilities, deposits, and short-term funding are short and reflexive. The quiet crisis before public panic is always the same. Asset values fall as yields rise, while liability costs rise as depositors demand more or leave. That squeezes net interest margins and forces institutions to choose between profitability and stability. If they sell assets, they crystallize losses. If they hold, they risk liquidity. If they hedge, hedges cost money and collateral. The market smells that squeeze. And it's not just banks, it's the dealer system. Dealers intermediate Treasury auctions and make markets in credit. But dealer balance sheets are not infinite. When regulatory constraints, risk limits, or volatility reduce dealer capacity, auction tails widen, bid-to-cover ratios become more important, and yields have to rise to clear supply. That yield rise is not a normal market move. In a leveraged world, it is a tightening of financial conditions that cascades through everything priced off the risk-free curve. Mortgage rates, corporate borrowing, emerging market refinancing, FX hedging costs, everything moves. This is how bond yields transmit stress across currencies. Higher U.S. yields can attract capital and strengthen the dollar, but they also increase the cost of dollar funding globally. For countries and corporates with dollar debts, that's a deflationary impulse. More cash flow must go to service dollar liabilities, leaving less for domestic growth. In some places, it looks like inflation, because the local currency weakens and imports become more expensive. In other places, it looks like deflation, because credit contracts and demand falls. The same shock can produce both outcomes, depending on balance sheet exposure. That's what people miss when they argue inflation versus deflation like it's a coin flip. In a dollar system stress event, inflation and deflation are transmitted through FX and credit simultaneously. It's not a debate, it's a map. And when the map lights up, precious metals are not a side story. They are the system's pressure gauges, and for many, pressure valves. Gold is the collateral of last resort in the minds of reserve managers and long-duration savers. Silver is the more volatile cousin with an industrial demand component and a smaller, tighter physical market that can gap violently when investment demand collides with thin inventories. In calm times, paper claims on metals, futures, unallocated accounts, ETFs, appear liquid substitutes for physical. In stress times, the distinction between paper and metal becomes the story. Delivery matters, premiums matter, inventories matter. When confidence cracks, participants begin to ask, can I get the metal or can I only get a cash settlement? That's when the mechanics turn boring into explosive. Here's the terrifying part. Paper metals markets are built on leverage and netting, just like funding markets. They function smoothly as long as most participants prefer cash exposure and do not demand delivery simultaneously. But if a liquidity shock pushes investors to seek uncorrelated assets and pushes industrial users to secure supply, the physical draw can exceed the system's comfort. Registered inventories at exchanges can be drawn down. Lease rates and forward curves can distort. Local premiums can rise even if futures prices are volatile or suppressed by forced selling elsewhere. This is the same pattern again. Setup is the belief that paper claims equal metal. Expansion is the growth of paper claims relative to deliverable stock. Crisis is delivery stress and premium spikes. Outcome is repricing, sometimes upward, sometimes via rule changes, sometimes via widening of the paper-physical spread that exposes the system's internal leverage. Now connect the dots like an adult. A bank panic headline is the late-stage symptom of a broader liquidity cycle turning. When liquidity is abundant, yield curves behave, vol is contained, and FX moves are orderly. When liquidity is withdrawn, through tighter policy, larger Treasury issuance, reduced dealer capacity, or a shock to confidence, volatility rises and the system moves from expansion into crisis. That transition is not announced, it is detected. It appears first in the places professionals watch: repo rates, swap spreads, cross-currency basis, auction metrics, bank CDS, and the behavior of safe collateral. Then it leaks into price. Sudden moves in long yields, dislocations between cash treasuries and futures, widening bid-ask spreads, and unusual behavior in gold and silver premiums. Finally, it hits narrative. Bitcoin moves, bank stress rumors, and public panic. The order matters because the order proves causality. The headline is not the cause. It is the permission slip for the crowd to notice the math. So when you hear BlackRock's $70 Bitcoin move just sparked panic, translate it. The real translation is the market is already sensitive to liquidity stress, and a visible institutional allocation accelerated the recognition that the marginal buyer of bank liabilities is less confident than yesterday. That recognition makes deposit behavior more reflexive, forces risk managers to shorten duration and raise liquidity buffers, and pressures funding costs upward. Then the bond market reacts. Auctions clear at higher yields, dealers step back, vol jumps, FX becomes unstable at the edges, especially for currencies that rely on dollar funding. Emerging markets and levered credit feel the squeeze. And somewhere in that loop, gold and silver start behaving not like commodities, but like monetary metals again, because the system's promise is being repriced in real time. This is why it can feel bigger than 2008, even before any single bank collapses. 2008 was the obvious failure of credit structures and securitization. This cycle is the slow-motion repricing of the global risk-free anchor under an unprecedented load of issuance, rollovers, a maturity mismatch, with a banking system still structurally exposed to duration and confidence. The tinder isn't subprime, it's refinancing. It's the relentless requirement that trillions roll at terms that may no longer exist. And when the terms change, everything that depended on the old terms becomes fragile simultaneously. We have the mechanism. We have two historical proofs. The only thing left is the present-day mapping, how this same skeleton is now expressing itself through the USD system, FX stress, inflation transmission, bond yields and auctions, and the metal market's paper versus physical fault lines. That mapping is not a theory exercise anymore. It's the only way to understand why the next moves won't be random. They'll be the next steps of the same clockwork. That mapping is not a theory exercise anymore. It's the only way to understand why the next moves won't be random. They'll be the next steps of the same clockwork. So now we add the final proof point, the third case study that completes the triangle. Not a gold peg, not a European currency band, but the modern architecture of dollar funding itself, where a banking crisis becomes a sovereign crisis, becomes a global FX crisis in the span of days, because everything is collateralized, rolled, and marked to market. Look at 1997, 1998, the Asian financial crisis, and its aftershocks into global markets. The setup was celebrated as modernization. Throughout the early 1990s, multiple Asian economies operated with semi-fixed or managed exchange rates, often effectively pegged to the US dollar. That peg-like stability invited capital inflows. Domestic credit boomed. Corporates borrowed in dollars because the rates looked cheaper, and the FX risk looked contained by the regime. Banks funded long projects with short funding, and the entire system leaned on the assumption that FX would remain stable and refinancing would remain open. Meanwhile, the expansion phase created the hidden mismatch. Dollar liabilities grew faster than the capacity to earn dollars. Reserves accumulated, but not enough to cover the scale of short-term external debt and contingent liabilities in the banking sector. The balance sheets looked fine until you asked the only question that matters in a dollar system. What happens if the currency moves and the dollar funding window narrows at the same time? Then the crisis stage arrived through a classic reflexive loop. Thailand devalued in July 1997 after defending the baht became impossible, and that single break cracked the perception of the entire region's stability. Speculative pressure spread, capital reversed, currencies weakened. The moment the FX regime lost credibility, the debt math inverted. Dollar debts became larger in local currency terms overnight, while domestic cash flows did not rise to match. That forced corporates and banks to scramble for dollars, but in a panic, dollars are not out there as a neutral medium. They are withheld, hoarded, repriced, funding costs spike, haircuts rise, credit lines get pulled. Central banks burn reserves defending pegs and providing liquidity, but reserves are a finite bridge. Once reserves fall below what markets believe is adequate, the market treats the defense as a countdown. The outcome becomes inevitable: devaluation, restructuring, IMF programs, forced deleveraging, and a deep domestic contraction, deflationary inactivity, inflationary and imported goods simultaneously. The mechanism repeats perfectly. Stable foundation via a dollar-linked FX promise. Overextension via dollar borrowing and maturity mismatch. Loss of control via a break in FX and funding rollover. Outcome via forced repricing of the currency and debt, with collateral damage across banking and corporate balance sheets. That is the final proof you need before we apply the mechanism to the present. Because today's global system is not the US plus some foreigners. It is a single dollar-centric funding network where the price of dollars is set at the margin by collateral and confidence, and where a stress in one channel instantly transmits through FX swaps, basis trades, and sovereign curves. Now, step by step, apply the same clockwork to today's USD system. Start with the setup. The foundation is the modern version of convertibility. Not gold, not a peg band, but the belief that US Treasuries are the world's clean collateral, that dollar funding is always there through repo and swaps, that the central bank can always restore order if volatility spikes. That belief is what makes a Treasury bill feel like cash, and a Treasury bond feel like a universal savings instrument. It is what allows dealers to intermediate, allows money market funds to lend overnight, and allows global corporates to hedge exposures through FX swaps at reasonable basis. It's what makes the dollar the settlement layer of global finance. The expansion and overextension phase is not subtle. It's embedded in the scale of issuance, the rollover calendar, and the way leverage is built on top of risk-free collateral. Debt doesn't have to default to create stress. It just has to roll at worse terms. When the Treasury issues more duration into the market, the private sector must absorb it, directly or indirectly, through dealer balance sheets, banks, funds, and foreign reserve managers. That absorption capacity is not infinite. It depends on risk appetite, regulation, and the hedging cost of holding that duration. When deficits stay large, the market stops treating auctions as routine and starts treating them as price discovery events. The bid to cover becomes more than a statistic. It becomes a real-time vote on whether the system can fund itself cheaply without forcing a repricing of all assets. And when the marginal buyer demands higher compensation, what rises is not just nominal yield, it's term premium. The extra yield investors demand for holding long duration under uncertainty. Term premium is a fear gauge disguised as math. Check. Now move to the crisis loss of control dynamics, which show up first in the plumbing. Watch real yields, not just nominal yields. Rising real yields tighten conditions everywhere because they are the discount rate for the entire asset complex. As real yields rise, long-duration assets, tech equities, speculative credit, venture-like risk, reprice downward, forcing deleveraging. At the same time, higher yields create mark-to-market losses for institutions holding large bond portfolios. That includes banks. Those losses might be unrealized on paper, but funding markets don't care about your accounting label when collateral is marked daily. If a bank, a hedge fund, or a dealer needs to post more collateral because rates moved against them, they must source it immediately. That means selling what can be sold, not what should be sold. Liquidity becomes forced. Enforced liquidity events are where panic starts, verified. The next channel is swap spreads and funding stress. When the system is calm, swap spreads behave within expected ranges, repo clears smoothly, and the basis between cash, treasuries, and futures stays contained. When the system is stressed, these relationships distort. Swap spreads can move sharply as dealers' balance sheet constraints bite, hedging demand surges, and the market reprices counterparty and liquidity risk. The treasury basis trade, where funds exploit small differences between treasury cash prices and futures prices using leverage, becomes a fault line. It works beautifully in stable conditions, low vol, stable funding, predictable haircuts, but it is structurally short volatility and long leverage. When vol rises or repo terms tighten, the trade can unwind violently. Unwinds mean selling cash treasuries to meet margin while futures positions adjust. That selling pressure pushes yields higher, not because growth is booming, but because leverage is being ripped out of the collateral stack. This is how you get sudden yield spikes that feel irrational. Until you remember the system is a set of levered trades sitting on top of risk-free instruments that are only risk-free if financing is stable. Undeniable. Now translate that into FX and global currency stress. The world is short dollars by design. A huge portion of global trade, debt, and derivatives settlement is dollar-denominated. When yields rise and funding tightens, the demand for dollars increases because everyone needs more dollars to meet collateral calls, service debt, and hedge exposures. That pushes the dollar higher against weaker currencies, but the mechanism is not America strong. It's dollar scarcity expensive. In FX swaps, the cross-currency basis can widen when non-US institutions must pay up to obtain dollars, reflecting stress in the offshore dollar system. When that happens, local central banks face a choice: defend the currency and tighten domestically into a slowdown, or let the currency weaken and import inflation. Either way, the system transmits stress. A stronger dollar tightens global financial conditions, pressures emerging markets, and forces global deleveraging. A weaker local currency raises import prices, fuels inflation prints, and can trigger political responses that further distort markets. This is how the same global shock becomes inflationary for consumers and deflationary for credit at the same time. Check, check. Now, zoom in on inflation-deflation transmission with adult clarity. In the expansion phase, liquidity injections and fiscal deficits can push nominal demand higher and inflate asset prices, while supply constraints keep goods inflation sticky. But once the funding system tightens, the deflationary impulse comes from credit contraction. Higher real yields, tighter lending standards, and weaker risk appetite reduce the availability of credit. That's deflationary in activity and asset prices. Simultaneously, if FX weakens for many countries, their local inflation can rise even as their economies slow. The public experiences higher prices. The system experiences lower growth and higher default risk. That duality is exactly what a dollar-centric world produces in stress, inflation in the lived economy, deflation in the balance sheet economy, and that's when policy becomes trapped. Tighten to fight inflation, and you accelerate credit stress. Ease to support credit, and you risk currency weakness and renewed inflation. That is the loss of control stage expressed as policy contradiction, verified. Now we get to the heart of the present: debt rollovers and auctions. The modern crisis trigger is often not a single default, but a sequence of clearing levels moving higher as more supply meets less balance sheet capacity. Treasury auctions are where the sovereign's funding meets the market's appetite. If bid to cover softens, if tails widen, if indirect bidders retreat, the message is simple. The market requires higher yields to absorb the paper. Higher yields then feed back into the deficit through higher interest expense, creating more issuance, more supply, more duration, more pressure. This is not ideology, it's arithmetic. When the marginal cost of funding rises, the entire system's discount rate rises. When the discount rate rises, asset prices fall. When asset prices fall, collateral shrinks. When collateral shrinks, funding tightens. And when funding tightens, auction absorption becomes more fragile. The system becomes a self-reinforcing loop driven by the refinancing calendar. Undeniable. Now add the dealer and repo layer. Dealers intermediate auctions and provide liquidity, but they do so under constraints. Balance sheet is finite, and in stress, balance sheet becomes the most valuable commodity in markets. Repo is the engine that turns treasuries into funding collateral. When repo terms tighten, rates rise, haircuts increase, tenors shorten, levered holders are forced to reduce exposure. That means selling. Selling pushes, yields up. Yields up, tighten repo further. This is the mechanical engine of a liquidity squeeze. It is why stress can appear even when the underlying credit quality of treasuries is not being questioned in a default sense. Liquidity is the question. The ability to finance positions at scale is the question. And when that question becomes uncertain, volatility surges. Volatility is not a mood. It's the market's way of repricing the probability of forced selling. Check. Risk asset volatility is the surface expression of this plumbing. When funding tightens and real yields rise, equities reprice, credit spreads widen, high-yield markets become selective, IPO windows close, leveraged strategies degross. The public sees a risk-off day. Professionals see a collateral event, and the banking system sits in the middle. Banks face deposit migration, higher competition for funding, and pressure on asset valuations. They also face regulatory and political constraints on how aggressively they can raise rates on deposits or restructure portfolios. That creates a slow squeeze that can suddenly become a fast squeeze if confidence shifts. A single headline can accelerate that shift. But the headline is only effective because the underlying structure is already brittle. Verified. Now, finally, the metals. The pressure valves. In this mechanism, gold and silver don't go up because fear. They reprice because the market is repricing the reliability of paper claims versus real settlement. Gold is the monetary hedge against the credibility of sovereign paper and the stability of real yields over time. Silver is both monetary and industrial, which makes it more volatile and more sensitive to physical constraints. In calm conditions, paper exposure dominates, futures contracts, unallocated accounts, synthetic exposure. In stress, participants begin to care about delivery and inventory. They ask whether their claim is a claim on metal or a claim on a promise. That is where premiums appear. You can have a screen price that looks stable while physical premiums rise, because the physical market is tighter than the paper market admits. You can have inventory drawdowns where visible stocks decline, registered availability tightens, and delivery demand becomes more significant. When that happens, the spread between paper and physical can widen. The system can respond with cash settlement incentives, rule adjustments, or simply higher prices to ration demand. The key is that metals become the release valve when the collateral system is under strain and confidence in paper settlement is questioned. Undeniable. Supply and demand mechanics matter here in a way most narratives ignore. Silver has a smaller above-ground investable float relative to the scale of potential investment demand, and its industrial demand means that in certain conditions, the market can be less flexible. If manufacturers, refiners, or mints face tighter supply, premiums can rise even if futures are volatile. Gold's supply is more stable, but demand is global and policy sensitive. Real yields, FX stability, and reserve manager behavior matter. When the dollar system tightens and policy credibility is questioned, gold can attract flows as a collateral substitute in the psychology of large holders. Meanwhile, if real yields rise aggressively, gold can face headwinds in paper markets even as physical buying persists, creating exactly the kind of paper-physical tension that signals stress rather than calm. Metals are not a one-line trade. They are a diagnostic tool for the state of the system's promises. Check. So where does this leave you right now in practical terms, without superstition, without hero worship, without comforting narratives? It leaves you in the last phase of the mechanism, the system approaching an outcome that will be chosen under constraint. The constraint is funding. The constraint is collateral. The constraint is politics. The outcome could be a period of higher volatility with repeated liquidity interventions. It could be a structural repricing of the long end via higher term premium. It could be a policy shift that changes how deficits are financed, or it could be an FX-driven adjustment that exports inflation and imports instability. But regardless of the path, the principle is the same. When the rollover machine becomes expensive, the system finds a way to reduce the real burden through devaluation, through inflation, through repression, through restructuring, or through some combination that's dressed up as stability. Verified. This time is not different. American exceptionalism is not a funding strategy. Tech will save us is not a Treasury auction bid. Modern optimism does not tighten swap spreads, does not narrow the cross-currency basis, does not restore dealer balance sheet capacity, and does not refill collateral buffers. Those are stories people tell when they don't want to look at the machine. Your edge is not predicting a headline. Your edge is watching the pressure points before the headline arrives. Here's what to watch if you don't want to become the liquidity exit. Watch the long end, not just nominal yields, but real yields and term premium behavior. Watch auction quality, tails, bid to cover, and who is actually absorbing supply. Watch funding stress, repo conditions, the behavior of swap spreads and signs of basis trade strain. Watch FX stress, the dollar's pace of tightening emerging market currency breaks, and the cost of dollar hedging implied in swap markets. Watch credit, spreads, bank CDS, and signs that private funding is repricing faster than the public narrative. And watch metals the right way. Not only futures prices, but physical premiums, delivery dynamics, and visible inventory trends that signal whether paper claims are being questioned. Undeniable. If you build your framework around those indicators, you stop reacting to noise and start hearing the machine. You don't need to bet the farm. You need to avoid being the last holder of crowded risk when funding turns. You need to understand that liquidity is not kindness. It's conditional. You need to stay aware of where leverage is hiding, because leverage is what gets liquidated when the system asks for collateral at the worst possible time. And if you want to stay ahead of the next phase, keep your attention on the plumbing, not the personalities. The next piece is how this machine was built to behave exactly this way, and what the next stage looks like when policymakers try to contain it without admitting what it is. The verdict is simple. The $70 headline was a flare, not the fire. The fire is the refinancing engine of a dollar system running hotter, tighter, and more volatile than the public is prepared to admit. So what will you watch when the next auction doesn't clear cleanly?